starting to look, within our own firms in terms of lessons learned. And thank you for the hydra-headed approach on this problem, systemic and, and institutional, Larry. And Henry, thank you for letting me draw you into the debate here. And if you, any point you want to jump back right in again. But Doug, didn't he just open up the door and said, we look at MF Global for risk management being leveraged 40 to 1, which seems outrageous since, even the Daily shows, Jon Stewart says, well, he just saw that as a challenge since Lehman was only 33 to 1. However, you say it's probably a lot more than that, maybe.
Well, first I have to be honest, and I have to say that I was actually told there was going to be mockery and torturing, and I actually still volunteered, knowing that there was mockery and torturing going to take place. But if you listen to the description of my background, you would understand why I was willing to subject myself to that. Because if you listen to my background, I actually was the head of proprietary trading at a major bank, JP Morgan, where post-Dodd-Frank, anybody who's in proprietary trading who's a bank is subject to torture and mockery. Right. So that's why I was willing to come today. Now, right. the other thing I would say is, I'm responsible for fixed income. Unfortunately, European debt is fixed income. It doesn't trade like fixed income, but unfortunately, it is fixed income. So, I routinely get questions every day from clients about what to do about European sovereign debt. And unfortunately, I didn't have the luxury of the video today, but I highly recommend to understand and explain to your clients how to deal and address with the issues of European sovereign debt. You need to go to the following commercial that's shown on YouTube. It's a commercial from Allstate. It's blind spot mayhem. You go YouTube, Allstate, blind spot mayhem, okay? What blind spot mayhem is the following. There's a guy, Mayhem. He's strapped on to the driver's side of the car. He's in your blind spot. He, Mr. Mayhem, which I would equate to either an EU leader or one of the central bankers, he then goes to the woman who's driving and goes, thumbs up. It's time to change lanes. And, of course, the woman changes lanes, bam, smash into a car accident, okay? That's what's going on in Europe. There's blind spot mayhem. Every day somebody comes up with somebody, gives you the risk, the thumbs up to change lanes, get out of safe assets, and go into that fast lane, and then naturally you get hit by a car, the market goes up 500 points, the next day it's like, what the hell happened, okay? So if you really want to explain what's going on in Europe and give your investors advice about when it's time to get out of safe assets and go into risky assets, that's probably the best commercial. Mr. Corzine probably should have taken that advice with respect to that issue. But the issue that, the topic at least, was Wall Street casino. Okay, well, that's a kind of a confusing issue, because if you think about a casino, they're the dealer. They don't lose. If you're a lottery, you know you always win, right? I set the rules up to always win. So why would you have these entities that are running casinos? They're the dealer. They should be setting up the rules in such a way that they should always win. Why would they ever get involved in playing the game? They know they're going to lose. Why would that ever happen? Okay, well, it's very interesting why that happens, because what happens when a casino sees a sharp guy who can count cards? It's like, oh, that's bad. This guy's going to count cards. I can't win. Then so what do? I kick the guy out of my casino. Well, why are we seeing these entities now trying to take, why did Corzine take this crazy risk if he's running a casino? Okay, well, a large, well-capitalized, well-bankrolled card counter entered the casino. And that entity cannot be kicked out of the casino. And I'm sure nobody knows who that entity is in this audience, because I'm sure you'll be shocked to learn who this well-capitalized card counter is that's now entered the casino, making it impossible for the casino to make money. You have an idea? The Fed. The Fed. The Fed is the large, well-capitalized. I mean, just think about it this way. I'll make a simple example. If you're a trader that trades treasuries 2 years and under, how do you make money? The Fed told me we're not going to move rates for the next 2 years. Okay? How do I make money trading 2-year notes? How do I make money trading 1-year bills? The Fed tells me the rate's going to be 0 for 2 years. I can't make any money. So if you can't make money running a casino, you go and play in somebody else's casino. Okay, I mean, the argument transcends beyond that. Okay, let's look at I was in the regulated banking industry 5, 6, 7 years ago. Every bank in the United States, what were they doing? They were saying, Fannie Mae and Freddie Mac, They have all these unfair advantages to us in the mortgage business. They have less regulation, less capital requirements, better accounting, all these unfair advantages. We can't participate against them. You need to shut them down because we banks can't make money in the mortgage origination and lending business. They have all these unfair advantages that we don't have. They can leverage more. They have better cost of fundings because of implicit guarantees. Those are all rational, reasonable arguments. Well, now today, look at who's replaced Fannie and Freddie in buying mortgages. The Fed. The Fed has far better capital requirements. The Fed certainly has better cost of funding than any bank in the United States of America. The Fed doesn't have regulatory capital requirements. The Fed has much better accounting. They don't have, available for sale. To them, it's all hold to maturity. You just have to accrue the income. There's no mark to market. At least when Fannie and Freddie used to buy mortgages, they actually used to try to hedge the interest rate risk of those mortgages. But when you're the Fed, you don't have to hedge interest rate risk, because the whole thing about hedging interest rate risk is because you're hedging the unknown exposure of what the Fed's going to do with interest rates. But when you're the Fed, you don't need to hedge interest rate exposure because you know what you're going to do. So as a result, how does a bank make money? How does a bank make money when you're competing against the Fed? Very difficult. So what do? You start punting. So as a result, MF Global, they looked at their casino revenues down. Can't make money running a casino. So what did they do? They went out and started betting in the casino. Makes absolutely no sense. So part of the problems that we're seeing, I already heard the point, and that's another industry that's getting completely killed. QE3 is a death knell for life insurance companies. Okay, think about it. Life insurance companies. I have long-term liabilities with guaranteed minimum crediting rates of 3%, maybe even higher, okay? And I am in the business of buying assets where now that I run the risk where the yield on those assets may not be able to support the crediting rate I credit on my liabilities. And most of the life insurance companies have assets that mature way before the liabilities. And as rates go down, the liabilities extend, because how many people who have a 4% cash value life insurance policy are going to surrender that policy when the best opportunity to invest is 3%? Right? So the liability extends on a life insurance company because nobody surrenders their policy. So rates go down, the yield curve flattens, the Fed buys more 30-year bonds to flatten the curve, thinking he's helping the economy. Instead, what has to happen? Well, that means that life insurance company needs to take more risk. He can't beat the return on his liability. He's got to take more risk. So that's why you're in this situation. If you ask Corzine why he did it, my core business, I can't make money. And that was one of the issues that occurred. Now, the other side of this equation, which I'll just briefly talk about, is regulation. I mean, regulation, the purpose of regulation is not to eliminate every molecule of risk in the world economy. That's what capital markets are supposed to do. Capital markets are supposed to price risk and trade risk. The key to regulation is to make sure that the parties who are not supposed to be exposed to risk and who could not necessarily get properly compensated for risk, they're supposed to be protected. The parties who knowingly take risk and should have the ability to price the risk they're taking, caveat emptor. So now let's look at MF Global situation. If you look at the MF Global situation, there's two parties. One, caveat emptor, one, a failure of regulation. Caveat emptor is, I made an unsecured loan, I lent money on an unsecured basis to MF Global. You should have done due diligence on what Corzine was doing, and you should have appropriately priced the risk for that particular instrument. You don't need regulation to deal with markets pricing of risks. You need to make sure there was transparency. We can talk about that. But you don't need a regulator to have two market participants knowingly taking risk exposure and need to regulate away the risk. The markets need to deal with that themselves. But now let's look at the other side. The other side is the customer account. Okay? Customer didn't get compensated for taking MF Global proprietary bet. Customer opened up a futures account or a brokerage account or whatever. There's no compensation for that. And he wasn't aware that he was indirectly exposed to MF Global and Corzine taking bets. That's where the regulation needed to function. And we've seen a complete breakdown in the most basic function, making sure customer accounts are not commingled with the house account. That's not complex. That doesn't need 2,500 pages of Dodd-Frank reform. It's simple, and all it requires you to do is make sure the customer accounts are segregated and not commingled. That's where regulation requires. So when you look at MF Global, don't mix up equity investors lost, debt investors lost. That's not where the regulation needed to be imposed. Where the regulation needed to be imposed was to protect the customer accounts, which is basic 101.